Consumer confidence took another big hit in August, according to the latest data from the Conference Board. The group's estimates are down at levels that are consistent with past recessionary periods. And while economists and policymakers are quick to dismiss this pessimism as overreactions to tariffs, the growing bust in the housing market, especially the latest data on pricing, shows this goes way beyond mere sentiment. In fact, the housing bust is getting to be uncomfortably prolonged and deflationary. And of course, markets have been warning about this for a long time, so here we are. The ratio of copper to gold, for example, has spent this entire month of August at rates we haven't seen in 40 years. Worse than 2020, lower than every single day during 2008 and 2009. Why? It's not about another massive crash in housing or the economy. In so many ways, it's worse. We're finally being forced to pay for the pandemic, which means a long and agonizing squeeze on jobs and incomes. It's exactly what the statistics are increasingly pointing to, more than you probably realize, as we'll see here. Not just in what the full range of employment numbers have shown, they're backed up by what's unfolding in this growing housing bust. Even the Federal Reserve in its own way is coming around to this. Well, it's being forced to come around. After downplaying the risks to the economy all year and dismissing the warning signs from consumers themselves, lo and behold, Fed Chair Powell is moving in their direction, not consumers moving closer to the Fed. And the confirmation keeps coming from all of these various places. It's not just consumer sentiment. Consumers are pulling back in spending. They're buying fewer houses to the point that housing prices are declining. It is indeed widespread. So widespread, even the Federal Reserve is beginning to realize this too. As I keep saying, the economy is becoming more, not less certain, and so all roads lead to lower interest rates. And what the Conference Board said today was, the Conference Board Consumer Confidence Index fell by 1.3 points in August to 97.4, down from 98.7 in July, which was revised up by 1.5 points. The Present Situation Index, which is based on consumers' assessment of current business and labor market conditions, fell by 1.6 points to 131.2. The Expectations Index, based on consumers' short-term outlook for income, business, and labor market conditions, decreased by 1.2 points to 74.8. Expectations remain below the threshold of 80 that typically signals a recession ahead. And remember, confidence plunged in the chaos of March and April, but it has not really come back. Stocks have, sure. Share indexes have soared and hit new all-time highs, but stocks are not the economy, no matter how many times people selling you stock advice claim that they are. Stocks like Jay Powell, or at least Jay Powell before Jackson Hole, they said that plunging consumer confidence was nothing more than an overreaction to tariffs. Moreover, they said it was only sentiment that was overreacting to tariffs. We've already seen this was never true. Consumer spending fell off sharply, even visibly, showing that consumer behavior was shifting in a material way. Revolving credit, remember I pointed that one out. Revolving credit card use, that backed up the point too. As does the growing and worsening downturn in housing, which the latest update on national prices only shows too well. Months after the April upset, not much has changed. Sentiment, like a few real economy measures, are at best only a little bit off their worst levels from a few months ago. And what's responsible for all this is not tariffs. It was never overreaction to tariffs. It's about, as consumers will tell you during these surveys and elsewhere, jobs and incomes, fears over job losses, and income potential that has quickly disappeared. I almost never do ads, and I say no to the vast majority of those that are brought to my attention, but I was thrilled to be able to work with today's video sponsor, Monetary Metals. And the reason is because they're solving a big problem, one that I've been highlighting for a very long period of time. Gold is a safe haven, but other than sitting in a vault, it doesn't do anything. Monetary Metals fixes that. They let you earn real yield paid in physical gold without giving up ownership. It's not a fund, it's not a paper claim, it's your gold working for you. Every month, more gold gets deposited into your account. It's simple, it's transparent, and it is fully insured. If you believe in gold as a long-term store of value as I do, this changes everything. Go to monetary-metals.com/Snyder. That's monetary-metals.com/Snyder for all the details. We absolutely thank them for being the sponsor of today's video, and now let's get back to it. As the conference board continued, the present situation and the expectation components both weakened. Notably, consumers' appraisal of current job availability declined for the 8th consecutive month, but stronger views of current business conditions mitigated the retreat in the present situation index, and stronger is the absolute wrong word to use there. Meanwhile, pessimism about future job availability inched even higher, and optimism about future income faded slightly or even more. Consumers have been concerned about jobs and incomes, not because they're concerned about jobs and incomes for no reason. We get it in all these statistics, including a bunch that you're maybe not aware of that even Jay Powell referenced at Jackson Hole. The employment situation already questionable at the very best to begin with. What we see in the data is that consumers have had every reason to be concerned and pessimistic, and it is not about tariffs and trade wars. And it's even showing up in places like the housing market. As we went over yesterday, the latest sales and construction figures from all the various housing sector sources. Today, we got home prices nationwide up till June, even though the data is a couple months behind. Yet these indexes show the downturn in prices extended yet another month, which we know is likely to have extended in July, as we saw from the sales and construction figures. That means at least through June, the housing market defied the stock market rebound, and that consumer pessimism is being carried out in a significant way in the real economy, in real estate. The Federal Housing Finance Agency's purchase-only price index for the national housing market fell another 0.18% in June from May. That was the third straight monthly decline after tumbling by 0.33% in April and then 0.12% in May. Before the last 3 months, home price appreciation had already stalled out, at least according to the FHFA's estimates. Prices had been on average flat in March and up just 0.11% back in February. So that means we've seen a 5-month period in the government's price numbers when something very big and very clear started to shift in home prices, which fits perfectly with the housing stats and developments that we went over in yesterday's video. And the situation is even worse when you look at it through the private Case-Shiller indexes. These tend to move more than the FHFA's anyway. It's just a slightly different, slightly more responsive take on home prices. And their national average declined by 0.3% in June from May. And more importantly, that was the 4th straight monthly decline going back to and including March. And during that 4-month period, home prices have fallen by 1.2% cumulatively across the country, driven largely by key markets like Florida or across the South, as we pointed out yesterday. But using the 20-city average from Case-Shiller, the results are nearly identical. Same 4-month drop in prices, this one totaling about 1.1%, which uses a narrower index, but it yields the same interpretation nonetheless, which suggests this really is taking place in the real economy. Consumers are not just pessimistic. In the real estate sector, both new building and existing homes being sold, there's now more supply than demand. And while there's been an increase in supply, there's been an equally notable decrease in demand. And everyone wants to blame it on mortgage rates when rates peaked almost 2 years ago. And in a healthy economy, it would have adjusted to these higher mortgage rates, which are actually falling. It isn't mortgage rates that are suppressing housing, just like interest rates overall are not suppressing the real economy. That's just what economists and central bankers say, because the former group has no idea how an economy works, and the latter group, the central bankers, all they have is interest rates, so they have to convince you and everyone else that interest rates are all that matter. But consumers and workers, which are basically the same thing, have been telling you all year what's really driving this widespread weakness into all these areas of the system. Some like to call it economic uncertainty when, as we keep seeing and keep saying, the economy is getting to be more, not less certain. As that certainty emerges more clearly, people don't like the look of it, so economic uncertainty sounds a lot less menacing. The real menace, that's the jobs market in the US, and it is having wide-reaching impacts, not just in terms of real estate or consumer behavior, even far afield overseas in places like Australia. As Bloomberg reported yesterday, Reece shares plunged by the most in almost 5 decades after the Australian plumbing supplies company reported a drop in full-year profit and warned of ongoing weakness in the U.S. housing market. The stock sank as much as 22% after net income fell 24%, And the company said, this is the important part, it anticipates the U.S. real estate market to be constrained. I love how they put that, constrained for 12 to 18 months, even as interest rates are projected to go lower, because interest rates are a reflection of weakness, not a solution to it. So everybody, I mean, you look at it all these different angles from the housing market in particular, this growing housing bust that is having more widespread impacts across certainly the U.S. economy, but around the world. It is a reflection that the weakness that we've been talking about, this consumer pessimism, is very real. It is having very real impacts, and those real impacts are not abating even if stocks go to increasingly high record highs. So even Fed chair and the FOMC, they're getting with the program to a certain extent. While Jay Powell did not mention the housing market at his Jackson Hole speech, falling home prices after the experience from 20 years ago, falling home prices in a weak property sector, they're definitely going to be weighing on the FOMC's decision-making too going forward. He also knows why. It's jobs, not tariffs. However, even now, the Fed is downplaying the risks and even the current reality through a couple of interpretations. What he said in his speech at Jackson Hole. First, that the data isn't all that bad, just somewhat concerning, even as he noted how the data hasn't been reliable, speaking specifically about the payroll numbers. The payroll numbers which provoked this dovish-sounding response from the Fed chair to begin with. And they're going to be revised even further and a lot lower, more than they already have been. And oddly enough, Powell also noted this in his speech, or at least in the footnotes to his speech. Second thing to be aware of, Powell also said the labor market was staying in balance between supply and demand. Therefore, it wasn't the bad type of slack or really unemployment where it would force wage rates down sharply. He called it unusual when it hasn't been unusual for 20 years. This is the same thing that we see over and over. And Powell basically said he wasn't overly concerned because of labor force dropouts, when labor force dropouts are absolutely a huge concern. Economists and central bankers love to ignore these people who can't find work, but the economy doesn't have the luxury of overlooking them, and neither do consumers who see this happening and worry they could be next. Now, what Powell actually said in Wyoming was, quote, labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year. It's gone more than just slowing, with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Again, downplaying the weakness, but yet recognizing it, and that's the important point. Overall, Powell continued, while the labor market appears to be in balance, it appears to him to be in balance, not to anyone else. It is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising, even though he's downplaying those risks. And if those risks materialize, which are far greater than he's willing to admit, they can do so quickly in the form of sharply higher layoffs and rising unemployment, the transition to the flat part of the beverage curve that we've been warning about and finding evidence for all year. So Powell says, I see it too. I just don't want to go all the way into it because there are a couple of these other factors that I have to keep in mind, which when you actually look at those factors are more reasons to be concerned than reasons to be not concerned. To begin, the slowing in the supply of workers isn't a slowing. Labor force participation has fallen. In July, it reached the lowest level yet on this current downswing. And it goes beyond slowing. The labor force itself is shrinking, especially when you account for discontinuities in the data, such as January's massive population control factor. But just this year alone, after January, in the 6 months since then, the labor force has outright declined by 400,000. That's not slowing. And it's even worse when you go beyond just those 400,000. The civilian non-institutional population has increased during those 6 months by 1.1 million, which means none of them entered the labor force. At the same time, 400,000 who were in it dropped out. Therefore, the participation rate went from 62.6% back in January down to 62.2% as of July. That's a huge red flag, and consumer confidence, not to mention declining home prices, back that up and then some. Now, before the next FOMC meeting next month, not only will we get another payroll report for the month of August, a few days later, the BLS will release the results of its latest quarterly census of employment and wages, which is known as the QCEW. Now, this is the most comprehensive employment data there is. Now, while these estimates are only for the first quarter of this year, because it takes the BLS 6 months to put them together, that's how large the survey sample is. So even though it's the first quarter of this year, the agency is also going to publish its preliminary benchmark revision to the establishment survey. And if you remember last year's, the preliminary benchmark and then the overall benchmark, it showed that more than 800,000 job gains everyone thought that the economy had gained between March of 2023 and March of 2024, they didn't happen. Now, we knew that before the preliminary figures and benchmark changes were released because the quarterly updates from the QCEW had shown the CES, or the establishment survey, were wildly overstating job gains from the very start of the forgot how to grow economy. And guess what? The QCEW numbers that we do have through the end of last year show the establishment survey has continued to wildly over-exaggerate payroll increases. More importantly, the QCEW's yearly change for the fourth quarter, and especially December, was well within the recession danger zone. It was so bad, it was less than any month or quarter during the entire 2010s, which was one of the crappiest decades for job gains in modern memory. What that means is exactly what consumers have been saying all year. The labor market was already in big trouble, in the danger zone, well within the danger zone, by the time 2025 began, which is why they reacted so harshly to any further threat to jobs and incomes, and it didn't matter what that threat would be. If the employment situation, the real one, was already on the verge of contraction before all this tariff stuff started, you can easily or more easily understand why it seems consumers have been so hypersensitive. They aren't being hyper anything. They're being far more realistic than the so-called experts, and certainly more realistic than policymakers have been, up to including Jay Powell at Jackson Hole. And so that explains not only consumer sentiment, it also explains cutting back on spending and putting off buying a house for the foreseeable future, as our friends in Australia are now projecting. Even Home Depot's CEO last week said, it's not interest rates, it's the economy, stupid. And we get that from the marketplace. As I've been saying, the markets have been pricing this direction for quite some time. That's why we're getting bull steepening in the Treasury curve as of today. The 2-year Treasury rate's down back under 370 again. The 10-year's at like 426. So the market is still bull steepening because all roads lead to lower rates. It's something that the copper to gold ratio has been projecting all this time too, even though it's taken a couple of detours, especially with copper having been driven higher, a lot higher, by a supply squeeze in anticipation of tariffs that didn't end up actually happening. But you look at the copper to gold ratio, with gold being sideways at its April highs or very near to it, and then copper now plunging back in August back down to fundamentals. Throughout the month of August, the copper to gold ratio has been less than every single day in 2020, less than every single day in 2008 and 2009. As of today, it's down at 0.00822%, which is not all that much off of its August 5th lows, which is in the immediate aftermath of the payroll report, when it was down at 0.00807%. But in the very simplest terms, what the ratio shows is that the market is expecting far more deflationary circumstances in money and economy than inflation or even reflationary circumstances. The copper to gold ratio, a dependable signal saying all roads lead to lower interest rates because the economic fundamentals and fears over the fundamentals, that's the gold side, show there is every reason to believe this, and all the data continues to come in along and aligned with it. So consumer sentiment remains weak at levels of pessimism that's consistent with past recessionary periods. And the primary fear driving that pessimism is employment, lack of jobs, and threats to incomes. And as it turns out, those threats aren't just an overreaction to tariffs. They're not really a reaction to tariffs at all. The labor data increasingly shows they are very real and already playing out here today. And more data says the full extent of this downside, like the QCEW, is yet to be revealed. But we don't need the government stats. We can already see it in a bunch of real-world ways, including the growing housing bust. That is a big one. Prices are declining. Demand is shrinking. Activity is falling. Even the hawks at the FOMC can't look away any longer. The data is becoming the economy is becoming more certain, not less. And it's becoming more certain that all roads lead to lower interest rates. We are becoming the very economy the markets have been warning us about. The results from both major retailers, Target and Home Depot, are also consistent with that future. Just that Home Depot CEO came out and actually said so. Whatever the details behind those in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.